Hi, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast. We are thrilled to have you join us today while we continue to shelter in place and stay safe. Joining us is David Burrows, our Chief Investment Strategist, and Brian McNichol and James Callahan, Portfolio Analysts with Barometer. During this webcast, we will provide a review of current market and economic conditions with a deeper dive into sectors of interest, including financials and semiconductors. As always, I encourage questions from participants via the chat, or please email me at phastings@barometercapital.ca. We will address your questions at the end of our webcast. And with that, I turn the conversation over to David Burrows. Hi, David.
Hey, Pam, thanks so much. Thanks everybody for tuning in today. I think that we've got some interesting stuff. Market continues to march on. I think that many are surprised with how strong the market has been. We bottomed on March the 23rd, and since then the market has worked its way higher. It was a 34% decline top to bottom, which we worked hard to mitigate on the way down. I was pretty pleased with how that went. And then since then, we've been watching this rally kind of unfold. We had a first leg that was driven probably purely by technicals. Things got very, very oversold. Market pulled back a little. We had rounds of fiscal and monetary stimulus. And then the market went into a holding pattern, or as we called it, a sorting phase, to sort the good from the bad and to let some water pass under the bridge. We've had a pretty significant slowdown in the number of cases of COVID-19. We've had some very clear leadership in the market and some very clear laggards. And we're slowly gathering more information about the virus. We're gathering more information about the potential solutions, both from a therapeutic standpoint and from a vaccine standpoint. We've seen how people are behaving and reacting. And the market is slowly collecting wisdom and positioning. So in our last call, we talked about the fact that we were seeing slowly improving breadth. And so what we like to do is it's important for us to find neighborhoods within the market that we can focus our attention on, where over time an expanding number of securities are participating in the rally. It means that buying is spreading. And that's a healthy thing in a market. We know if I went back over time, when you get to a point where almost nothing is performing well, this is a percentage point reading on the side. When percentage stocks in uptrends falls to a very low level, below 30%, it tends to be around a market bottom. And when you see breadth start to expand, it means that more stocks are starting to perform better. That's healthy. And we like to be invested in markets where breadth is expanding. When breadth is contracting, we might own 20 or 30 great companies, but if one by one they're rolling over and heading south, that's not a healthy market. So around the world, we're seeing some improvements in breadth. There's very clear winners. There have been some laggards, but in general, things have been slowly improving. Since the last call, last Wednesday, we moved from 44% of stocks in the NYSE in uptrends to 58% of stocks. So quite a lot of broadening over the course of the week. That's healthy. You know, we know that there are 10 or 15 really big names in this market that have been leading the way. But in order for the rally to continue, we need to see the market broaden. So if you take the S&P off the lows, we've traded now back up to the long-term moving average, which is a battleground. That's the 150-day moving average, around 3,000 on the S&P. So market's still about 11% below the highs, but it's come a long way off the lows. And that's a good thing. Now, in our last call, we talked about the fact that the market was really bifurcated. There have been a lot of very cautious investors who, based on the news that they're reading and the economic data they're seeing, say, I want no part of this. Our view is let the market show us where the strength is. Market rallies unfold over time. They evolve. They start with some initial leadership, and we have to see where things go. It's important, though, to understand the positioning. You can see that as of the most recent week, Still, speculators have been net short the market, and that's a healthy thing because it means as it rallies, they are forced to cover. We may have seen some of that this week. We know we got to a point where sentiment had been extremely negative. Sentiment has slowly normalized. So it's not exuberant. It's not really pessimistic. It's really not a factor at this point. But we've had new people join the party. So this is an interesting chart that shows the number of stock positions held at Robinhood. And for those that don't know, Robinhood is a discount broker. There's free trading, and it's the favorite discount broker of the millennial generation. Their app is very simple. Their website is very simple. And they've had a giant increase in the number of accounts signed up and the number of positions investors are holding. Now, whether or not this matters in the short run, it does matter in the long run because the millennial cohort has been notably absent from stock markets as they saw their parents go through the financial crisis in 2008-9. They also heard that that was a generational buying opportunity, and they've taken it to heart. So while people have been sheltered in place, and while there's been no sports to bet on, they've decided that the stock market is a place that they're interested in. And so primarily, private investors have been the big investors going through this rally. Professional investors have been very, very cautious. And that's an interesting dichotomy. So we know that the S&P is still sort of 11% away from the highs. The Nasdaq, which houses a lot of the big name stocks that lots of people wanted to focus in, is trading fairly close to the old highs, which is remarkable. We said early on, the least likely outcome that we thought would happen was a V-shaped recovery for the stock market. And whether or not we're going to have a V-shaped recovery in the economy, this is what investors have bet on. So the market has a way of discounting the future. It looks 8 to 12 months out. It says, what do we think is going to be happening? The belief by investors is that many of the companies that make up the NASDAQ, many of which are in structurally advantaged industries, have a tailwind, and that they have come through this very successfully. And that's why the NASDAQ has performed so well. Many of the companies haven't missed a beat. The Dow Industrials, on the other hand, 15% still below the highs, has had weak relative price strength versus the market. But you can see over the last few days, the relative strength has started to pick up, and the industrials have started to join the rally. That's a healthy thing. TSX has been a laggard, and we should be used to that by now, just about 16% below the highs, and is yet to take out these most recent consolidation highs. We'll see whether that comes next. But that's one of the reasons we've been more focused in the US. The US stock market has been very strong. The global stock market, not nearly as strong. Now, that could have to do with the industries in the market, technology, healthcare, and so on. It could also have to do with the extreme moves in monetary and fiscal policy to support markets and provide liquidity. But again, the US has been our chosen hunting ground, and that's where most of our investments lie. Emerging markets still relatively underperforming. So still across the globe is a market of haves and have-nots. From a sector perspective, leadership has very clearly been in technology, although over the last week, really no further movement higher. In fact, they've pulled back a little bit based on the fact there's been some rotation. So cloud-based computing, structurally advantaged, basically back to the highs. Great hunting ground for investment positions. We've got lots of exposure here. The COVID virus is not slowing down this theme. Internet commerce. We all know how many Amazon boxes are coming to our door. We talked about Shopify recently. That's one of our big holdings. Again, very strong, but quieter this week. Healthcare, very strong off the bottom, relatively underperforming a little bit over the last week as they are digesting their gains. Now, it's healthy for leading groups to stop and digest their gains. Markets had a great rally. And we wanted to see leadership expand into some other groups. Up to this point, we've had technology, we've had healthcare, we've had internet commerce, we've had alternative energy, we've had biotech within the healthcare space, we've had gold miners, which pulled back a little bit again this week. Still a very constructive move, and the printing of money is not slowing down. So we think that this has some real legs to it, but we're seeing some expansion. If you took all of the sectors and compare them versus the S&P, you can see there's some real outliers to the upside and there's some real outliers to the downside. But what you'll notice is some of the outliers to the upside underperformed this week. Some of the outliers to the downside actually really outperformed this week. In fact, statistically, it's quite remarkable in the last couple of days. Small cap stocks and value-oriented companies, more economically sensitive, had a 4 standard deviation move. That means it's a tiny fraction of 1% of the occurrences. You have that much outperformance versus the market. And strangely enough, the momentum sectors had significant underperformance over a couple of days, 4 standard deviation underperformance. So that didn't play well to our portfolios over the last couple of days. We have said along the way, we should expect it to be a little bit bumpy. And we don't think that this is enough to make significant changes, but we do take note that we're seeing a broadening of the rally. The positioning in oil, copper, the equity indices, and the versus the inverse of bonds in US dollar, positioning very defensively in the market, maybe showing some signs of reversing. That would ultimately be healthy. So now we have had some exposure to a couple of long-term structural themes that are highly economically sensitive, and they have participated. So they not only are economically sensitive, but have a strong structural backdrop like semiconductors. We know that 5G is coming with COVID or not. We know that devices are becoming connected to the internet, whether we have COVID or not. And so the semiconductors have performed remarkably well. And within the semiconductor group, we have a number of holdings. I've asked James Callahan to come on the call and talk a little bit about the semiconductor theme as a whole, and then talk a little bit about one of our favorite names. So James, do you want to jump in?
Yeah, absolutely. Thanks, Dave. So in terms of the theme as a whole, really, I do get this question sometimes, but it's, what is a semiconductor? And the best way to think about it is that it's the most basic building block of a computer. It's where the computations take place. And over time, the technology has evolved through semiconductor manufacturing facilities called foundries, being able to pack gates more densely onto chips, resulting in quicker processing speeds. The tech itself is innovated upon at a rapid pace, and the penalty for not keeping up can be really severe and comes in the form of market share loss. The cyclicality of the industry comes from that rapid pace of innovation. So semiconductors generally have a short lifespan before a much better iteration comes out. And in your home PC, it might be acceptable. You hang on for a few obsolete generations, but in enterprise and data center end markets, it's not acceptable, and you need the most current technology. This begets front-loaded demand for the newer generation products and constrained supply. So prices increase, then as supply is built, demand falls off. This used to lead to a glut in supply and still does, but to a lesser degree. These companies have gotten a lot better at managing the cyclicality over the past about 10 years, and are worthy of a higher multiple based on that. So within the industry itself, one of our favorite companies, and it has been for some time now, even outside of the semiconductor industry, it's been a strong positive contributor to all the portfolios that it's been in both last year and this year. So I talked about NVIDIA on this call about a month ago now. So it's probably timely to have a refresher on what they do and to talk about some recent developments. So NVIDIA makes graphics processing units, so GPUs. There aren't that many GPU manufacturers in both consumer and data center end markets. NVIDIA has the majority of market share, and AMD only has a bit. In terms of the tech, on the low to mid-tier consumer side, AMD tech is only slightly worse, so they can compete a little bit on price. And on the upper end consumer side and in data centers, there's really no competition. NVIDIA has, over and above the best product. So in terms of revenue, how it's split up by segment, that's changed since we last talked, since they reported quarterly numbers last week. And given how fast the data center business grew, now gaming represents about 43% of revenue and data centers about 37%. The remaining 20% is a mix between end markets like AI development, where they use GPUs to train artificial intelligence, and professional visualization. So think really complex graphics design and animation, And then also autonomous driving, which is a smaller part of the business now, but does give some good optionality. So the quarter they reported last week was very strong. Overall revenue grew almost 40% year over year. It was driven by data center, but with pretty good contribution from gaming as well. So that's the first thing that's changed since I last spoke NVIDIA. We have confirmation now that the company is continuing to execute really well. We thought we would see strength in data center, and NVIDIA cleared a very high bar there, so that's just great to see. And then the second thing are some new products that were announced 2 weeks ago at their annual conference. So I'll spare you diving too deep into the weeds, but they announced a new generation of data center chip that makes a leap over the previous generation bigger than we've seen in a number of generations, which is fantastic. They're also starting to release some data center focused products implementing Mellanox technology, which is a company that NVIDIA acquired. The deal spent some time kind of tied up in antitrust regulatory approval, but now has the green light as of the end of April. So what Mellanox does is they make networking products for data centers. So they're increasing the throughput of a server stack, which is the same thing that a GPU does in a data center. So from an acquisition standpoint, it makes total sense. And it's great to see them coming to product with the market so soon. So that's why we like it. It's been among our highest conviction ideas, just based on the secular growth profiles of all their end markets and what really is best in class execution. So our view really is that as long as semis continue to work, NVIDIA will work. In terms of our other semi exposures, we've stayed pretty high up the cap scale during this rally, and we've been a bit selective. We took a decent position in Intel, given it's a bit more stable. They do benefit from data center build out as well, since they have majority market share on the CPU side. And if there's a flight to stability within the group, they probably do benefit. And then it's worth mentioning too, just given headlines, we've stayed away from the semi equipment manufacturers, given that over the last few months, the Trump administration really has ramped up the rhetoric towards China. And there's been a particular focus on restricting Huawei's ability to produce chips. So there's been talk that semi equipment sales into China might be further restricted. And that's really only on the US side. We're just seeing some Chinese retaliation. It's come in the form of crackdowns in Hong Kong, and it's really not been focused on the tech sector, but there is still the possibility we see something that impacts tech as well. But that's really an evolving situation. And so just recently, we've started to move down the cap scale in semis with a small position, microchip technology. So they make microcontrollers and analog semis. But as more money gets put to work in the semis, many of the mid-cap names are starting to play a bit of catch up. So if the macro holds, we'll probably look to add more names there.
That's great, James. Thank you so much for that. That's
Thanks,
a great
Dave.
primer on semiconductors. The reason that we care so much is that this is a sector that has an almost unstoppable heartbeat in moving forward. And they are classic examples of the things that we look for, which are companies that are good getting better, as opposed to broken getting fixed. We've also had some focus in animation and robotics, which in the industrial space, even though it's economically sensitive, again, plays into the current COVID themes. But really that has been the extent of our economically sensitive exposure. Now, when we were on the last time, we talked about the fact that we'd had this technical rally, a bounce on optimism, and a period of workout where the market was doing some sorting. We needed to see what came next, and this is what's come next. In the last week, we've taken out the high end of this trading range for the market and started to move higher. And it's not just on the sectors that we've been focused in previously. We've started to see some expansion and breadth, money moving into some sectors that are actually more dependent on recovery. And we don't try and foresee this. We don't try and guess when it might happen, because when it starts, it can go on for a long time. So if we look at the ETF for the S&P 500 high beta cohort of companies that are highly economically sensitive, you can see that we've had a really big lift here in the last couple of days. Now, that's a great start. We have to see whether this is something that will follow through and go under the surface to see what's there. So in a couple of the key groups that people seem to care about and that are important, the transports have had 2 big days in the last 2 days. We're still well below the long-term moving averages, but we've had a big pickup in performance. And this is something that we have to take a close look at. In the banks, which notably were absent, trading near absolute and relative lows only a week ago, have had quite a move in the last couple of days. Now, I got asked on BNN this morning if the earnings that came from Bank of Nova Scotia were seen as positive, and that's why the group had a big move. I had to say, look, the U.S. bank sector was up almost 8% yesterday, and it probably had very little to do with Scotia, but they all are not the same. They all behave differently, and we are seeing some turn here. It's really important that we see the financials join this rally, because that means people start to believe that there is economic growth on the other side of this virus, and that the body blows that many industries have taken going through this virus are not going to be substantial enough to make a significant dent in the balance sheets of the banks. So in the last couple of days, we've had earnings reports from some of the Canadian banks. Brian McNichol spent a bunch of time working on them. Even though this was an underweighted sector for us, and that's hurt us in the last couple of days, we did have some exposure. And I thought maybe Brian could talk a little bit about what the expectation was coming into the earnings period, what investors and analysts cared about, and who did what, because this group is not homogenous. They are all different, and you really have to pick your spots. So Brian, what are your thoughts on expectations coming into the earnings and what we saw?
Yeah, thanks, Dave. So, heading into the quarter, there were really two major questions that were top of mind of both buy-side and sell-side analysts. One being the elevated level of provisions that have been set aside for each bank's loan books. So loan provisions are essentially the amount added to a bank's allowance for credit losses, which management teams bring to a level that they deem as adequate to absorb all credit-related losses within the portfolio. Unfortunately, it is a headwind to the overall earnings profile. So, we are in a period of elevated provisions given COVID. So this is leading to a 22% decline in EPS for the group for this quarter. However, in an environment such as this, it's better to be taking big provisions now so that the banks are prepared and investors don't see any big surprises down the road with respect to the earnings or capital health. The next big thing was the overall strength of the bank's capital position. So this is really just to put to rest any speculation that Canadian banks would need to cut their dividend down the road. The capital ratio is a ratio of a bank's core capital to their risk-rated assets. Regulators track each bank's capital ratio to ensure that they can absorb a reasonable amount of loss. So it's important to maintain an elevated capital ratio above the minimum in order to ensure that the bank's capital allocation priorities, such as share buybacks, M&A, and most importantly, dividend stability, can remain in place. And what we've seen so far from Bank of Nova Scotia, National Bank, Royal Bank, and BMO is we are definitely in a period of elevated provisions, but all four of the banks that have reported have been able to maintain a pretty solid capital ratio well above the minimum.
So Brian, maybe you could break out for us a couple of the names that we do have, investments in Canadian banks, and how they differed going through the earnings period.
Definitely. So big one today was National Bank. It was up about 7.5% off earnings. So we really love National Bank from a growth perspective. Stripping out all earnings before tax and provisions, earnings growth was 20% with 14% revenue growth and very strong positive operating leverage, essentially meaning that their revenue growth outpaced their expense growth by quite a bit. And outside of that, despite the fact that we did see elevated provisions, their overall operating leverage was able to offset that, and they're able to put up some pretty decent earnings that came well in line. Overall capital ratio did fall on a sequential basis, but it's at the higher end of analysts' expectations and is one of the top of the big six banks in terms of capital positioning. The next big bank that we love is Royal Bank, and this is largely from a capital perspective. So they sit at the top of the big six with regards to the capital ratio. Now, they did take a massive provision this quarter, coming in at $2.8 billion in provisions for their loan book when expectations were for $1.8 billion. However, the market did reward them for this. So despite the level of provision significantly impacting their EPS for the quarter, RBC is historically fairly conservative, and the market saw this as a prudent way to manage risk going forward.
That's great. So Brian, tell me, obviously the most important thing that investors care about on the banks are the dividends. And yep. From our standpoint, pretty comfortable with the safety of the dividends and the banks that we own.
Definitely. So we've heard this from all the CEOs on the investor calls. stating that none of their capital ratios expect to be anywhere close to the minimum. So this really does alleviate concerns for the banks. And I personally believe that dividend cuts are truly not in the discussion going forward.
It's interesting, we always talk about how the market telegraphs. And, one of the reasons that we were in National Bank, along with the fundamental characteristics, which were that there was growth, more growth than some of their competitors, obviously share price had been relatively outperforming. So even coming into the earnings, we had been as high already as 50% recovery of the almost 50% decline, which the Canadian banks went through. And of course, the earnings they come in a little bit better. Mark Bank's up 7%. Royal coming into the earnings, not as strong as National Bank, had recovered 38% of its decline after, again, a 48% decline, up almost 5% today, again, through the 50% mark. You break out the banks are all different. Bank of Montreal coming in was trading really close to the lows and still has yet to even recapture 30% of the decline. So targeting in these Canadian banks, I think, is really important, just as it is in the U.S. banks. Our biggest holding in U.S. banks is JP Morgan, which we consider to be sort of the cream of the crop. And Jamie Dimon this week made some quite positive comments about the U.S. consumer and the fact that they were strong coming into the crisis, and they have been able to maintain some of their buying power as we've gone through. So banks certainly getting better. We're certainly seeing some improvement in industrials. These are very early. I mean, these are 2 days of big moves. We have to see whether the market can hold here. Arguably, we still think that there will be bumpiness in this market. We're coming into summer. Summer can be a bit of a sloppy period, and there's still some areas of real underperformance. Real estate investment trusts continue to be very weak, and they're very economically sensitive. The utilities, which I think are quite over-owned, while they have good dividends, still relatively weak performers, make new relative lows versus markets. These are groups we've continued to back our way out of. And really, again, our job is to identify areas that are seeing net new buyers, where there are fundamentally constructive companies, things that are good getting better, and we seem to have some pretty good targets. So look, we continue to be in a structural bull market in stocks. We certainly challenged the long uptrend that we've been in since 2013, coming out of the secular bear market we were in for 13 years. We think that it is not going to be straight higher. We think we are going to continue to have to be very targeted. We think the Nasdaq continues to be the strength globally. And so we have a lot of exposure in these large structural themes. There are certainly going to be weeks where our positions pull back and consolidate. And we're going to see short squeezes in stuff that is under-owned. And we hope to continue to see the market's breadth expand. If we start to see deterioration in particular areas, it is beyond just what is a normal pullback. If we start to see economic data decelerate from its initial uptick, if we start to see the market react poorly to the COVID numbers as people come out of their homes and re-engage, we can certainly get defensive, and we'll have no problem doing that. But at this point, we have to go day by day and take the data as it comes. And we'll continue to work our way through and forward. So I want to thank everybody for joining today. If there's any questions, Pam, certainly we can take a crack at 2 or 3 of them.
Thanks, Dave. Just one question today. Are you seeing a rotation out of tech, or are tech stocks just checking back off of gains, but still on trend?
It's a great question, and I'll try and answer it this way. If you take a look, for instance, at NVIDIA, yesterday was a down day, and then today we opened and went well lower, but by the end of the day recovered. So there's no question that tech became a source of capital for some investors to rotate some of their holdings. But look at the way the tech sector pulled back to the moving average and rallied off it. So at this point, there is really nothing to say that this group is losing its steam. There may be some money spreading to other groups. There's plenty of cash on the sidelines that can come in. certainly the institutional community is way underinvested. We're very, very pleased at how well our equity portfolio has done, positive, the long short portfolio, significantly stronger. Yield-oriented portfolios have been tougher so far because the yield sectors have lagged a little bit. But I do think that tech continues to be clear leadership, and we will give it benefit of the doubt. The same way as, the golds, I think, very, very well suited to a period where we're seeing lots of money printing, but, everything needs to pull back. This market could easily pull back into summer 8 or 10%. And I think that we have to expect that that's very possible. So we're just being very careful about not getting out over our skis. Some of our portfolios are more aggressive, like equity and long short. Some of them are set up, quite defensively right now to be a moderating factor if and when we do get this pullback. And the whole thing is sort of aimed at making up the portfolio structure.
Dave, one more question that just snuck in. You mentioned REITs and that you're backing out of this area. Could you expand on why? Maybe you could elaborate on commercial REITs and also positioning on residential REITs.
Okay, so let's start out with the fact that this has been one of the most widely held sectors by investors because it has done well for a very long time. And why has it done well for a really long time? We've had steadily falling interest rates to the lowest levels in a generation. So falling interest rates on a leveraged asset means that the asset can be worth more. So they've done really well. So first of all, they're really broadly held. There's nobody who really needs a lot more REIT exposure, either institution or individual. When you break down the different types of REITs, they're all different. But clearly, there is going to be some challenge for the retail REITs, right? REITs that own retail properties, because there's going to be some solvency issues. We're hearing about it with companies like Neiman Marcus and JCPenney. I think that the office REITs, may well have a challenge. I know that when we think about our office space, and we have a lovely office, and it's got a nice spot for everybody. But a year from now, when our lease comes up, I question whether we need as much space as we have, because there's a lot of people working really effectively remotely. So I think that we're not the only ones looking at that. So depending what we're looking at, there could be some weakness in rent factors, and they would be an obvious group that could be impacted by ongoing impact of the virus.
Thanks so much, Dave. That concludes our questions for today. And if you have any other final thoughts, please let us know.
Thanks everybody for joining today. I think that next Wednesday, we're going to deviate. We're going to do a call, and we're going to focus on some of the common areas for alternative investing, areas outside of public markets. One of the reasons that we did our recent transaction with the partners from Roundtable is that they've been focused on some assets outside of the stock market and public markets. These can be a great diversifier. We're going to do a little bit of a primer on the alternative asset classes and a couple of ideas that we're working on that I think will be relevant for many of our clients over the next number of months. So hopefully you can tune in for that. We'll send an introduction to the call out over the next couple of days. And I want to thank everybody for taking the time to tune in. We appreciate the fact that you give us your time, and we really appreciate the fact that you are clients. And if you have friends or relations that you think could benefit from what we're doing, we certainly are in the business of trying to grow, and we'd love to continue to talk to new people. So any introductions would certainly be appreciated. Thanks very much, everyone, and we'll talk to you again next week.